Just by the show of hands, how many people in here get involved with estate planning or trust and estate taxation or estate tax, fiduciary income tax, any of those kinds of issues? Okay, maybe 40% of the room. So as to the other 60%, this will be either introductory or remindery. Is that a word? Remindery? If it's not, I just made it up. So we're gonna be kind of at a 30,000 foot level on most of this stuff. We're gonna take a couple of little tiny deep dives for those of you who kind of do this stuff regularly. Let me introduce myself. Whoops, I probably just tapped on the microphone. Sorry, back there. My name is David Spence. I head up the, we call it the Wealth Strategies practice with the Royse law firm. It includes estate planning. It includes asset protection planning. We do a lot of income and estate tax and gift tax planning for our clients as well. Let me introduce my colleague, Michael Zosky. Michael works with me every day, except when he calls in sick, which has happened, I think, twice in 3 years. And we need to get a thicker chain. Anyway, so we'll be talking to you about kind of what we do in the Wealth Strategies practice. And what we wanted to do is introduce what we call the top 5 wealth strategies for 2015-2016. And when I say the top 5 wealth strategies, what I mean is the top 5 wealth strategies that maybe you haven't used before, but you ought to think about given the world that we're in today. So let's start with the fine print. Fine print is, don't use this stuff to sell. Okay. Let's start with the estate planning milieu. Now, milieu is a $9 word that means environment, okay? And I don't speak French, but that's what I looked it up on dictionary.com, and that's what they said, something like that. Anyway, so what is our estate planning milieu that we're in today? Well, we have very high marginal tax rates, particularly here in California. We have low interest rates. Market interest rates are very low. That means the government interest rates are very low. So that presents particular opportunities and particular challenges in some cases. What are our capital markets conditions? Well, we got somebody here, Steve Morgan, who could probably give us a whole 3-hour speech on capital market conditions. I'm not going to, but suffice it to say we've been in a bull market for a number of years now, so asset values have been rising. Certainly real estate values in this valley have been rising. How long they'll continue to rise, that's a question for other people other than me. But that's part of the environment that we're in today. Tax planning objectives. Given the changes in the tax law over the last 5 years, our tax planning objectives have undergone some changes because the estate and gift tax marginal rate is 40%, and here in California at least, our capital gain tax rate could be anywhere between 33 and up, okay? So we're talking about, in some cases, very small difference in terms of marginal tax rates between the capital gain rates and the estate tax rates. The other thing that has happened is that the influence of specific state estate tax laws has gone up. When I say the influence has gone up, their importance has increased because there have been some changes in the federal law that have affected how states have dealt with estate taxes in general. Let me give you an example. The old law was that on your federal estate tax return, you got a credit for taxes paid to a state, so state estate tax credit, okay? And so what that meant is that most states had what we called a pickup tax, and what that did is basically the state said, Certainly California did this and many other states did this. They said, we're going to charge you whatever the maximum credit that the federal government gives you, send it to us, and that will be your, so we're not adding to your overall estate tax burden. We're just taking our share of it, okay? The federal government then eliminated the state estate tax, or the state estate tax credit. And what that did is it meant that since the credit was zero, the state's pickup tax became zero, including California's. And so there was no state estate tax. Some states have remedied that by enacting their own estate tax rules. California, a little behind the times, has not made any change, which is frankly shocking to me. So California has no estate tax, but many other states do. And so the effect of what if I own property in Oregon or New York or fill in the blank, Iowa, Missouri, Kansas, wherever. Sounds like college game day. Okay. And finally, cross-border issues. The environment that we live in here in Silicon Valley is so diverse in terms of the nationalities of our clients. And when we're talking about our clients, we mean individuals. Okay? And so because of, as Roger said, I think earlier, probably 50% of our clients either are recent immigrants, temporary residents, have business interests overseas or in other countries, have assets in other countries, live in other countries and have assets in the U.S., live in other countries and have beneficiaries in the U.S., et cetera, et cetera, et cetera. Okay? And so all of those things come into play and become sometimes very non-intuitive. And so we have to be aware of those issues. So that's kind of the milieu that we're in today in the estate planning and estate tax world. So let me just give you a little foundation for those of you who don't do this stuff every day. I'll be very quick for those of you who deal with this every day. You try and stay awake. Okay, estate and gift tax exemption. Every U.S. citizen or resident, I'm going to get to the definition of that in a second, gets a $5.43 million exemption. Okay, that exemption is portable to your spouse, but you have to die. Okay, so you can't just give it to your spouse, but you can die and leave it to your spouse, and your spouse gets it, and that means your spouse then has $10.86 million, assuming she hasn't used any. Okay, there's a 40% rate on any estate over that amount that's not going to charity or to a surviving spouse. Okay, qualifying surviving spouse. Second, the generation skipping transfer tax exemption. That is, the generation skipping transfer tax is a tax on your right to give assets to the next, not the next generation, but 2 generations down, your grandchildren. The idea was, hey, if I skip my children's generation, particularly if I'm Bill Gates, if I skip my children's generation, I'm going to skip one level of estate tax, and so I'll just give it directly to my grandchildren. That's a great idea. Congress got wise to that many years ago, and so they enacted the generation skipping transfer tax. But you do get an exemption from generation skipping transfer tax. Happens to be the same number today as the estate tax exemption, but it hasn't always been, and so you need to be aware of that. There's a 40% generation skipping transfer tax applied to any transfers to a grandchild, essentially, in excess of the exemption. No portability for the GST exemption. So if I die and I have not used my generation skipping transfer tax exemption, my wife doesn't get it. It's use it or lose it, okay? Finally, non-resident aliens. Let's talk about residents. Roger mentioned it in his presentation. For income tax purposes, a resident is anybody who's here more than 183 days, substantial presence test, green card, all of those kinds of things, right? Guess what? In the estate tax realm, just as Roger mentioned, the rules are all different. Okay? In fact, it's almost like there are no rules. The statute uses the term resident, but the regulations, the IRS, we should have talked to Mark Everson when he was here about this. The IRS came in and said, well, we know the statute says resident, but what we really think it means is domicile. Okay? And so there's a whole set of law around domicile. And so domicile can be very different from resident. I can be a resident for income tax purposes and not a domiciliary for estate tax purposes. And arguably vice versa. Let me give you an example. There was a case a number of years ago, I wish I could remember the name of it, I can't, in which the taxpayer claimed to be a non-resident alien. And by being a non-resident alien, they did not have to pay taxes on their non-US property. Okay? The IRS said, we think you are a resident alien. Okay? And the estate of the decedent said, well, in order to say this person was a resident under the law, you would be assuming that this person had the intent of breaking the U.S. immigration laws. In other words, they would have had to overstay their visa, which they had not done at the time of death, but they would have had to do that and have the intent of committing a federal crime in order to be considered a resident. Taxpayer takes it to tax court. It actually went to the appeals court, and the appeals court bounced it back to the tax court. It was probably settled. But the point is, the appeals court said that, yes, one could be here on a temporary visa and be a domiciliary for U.S. estate tax purposes. That's what the court said. What David Spence says to that is, well, cannot the opposite also be true then? Could I be a green card holder and not really have the intent of being here ad infinitum, and therefore not be a resident? The answer is, I don't know, but that's something to think about. There is nothing in the law that specifically says that could not be true, okay? So in theory, one could be a green card holder and not be a resident for estate tax purposes. In theory. Okay. Theory doesn't help much if you have a bill. Okay. Non-resident aliens get a $60,000 estate tax exemption. $60,000 as compared to $5.43 million. Okay? It's virtually zero. It might as well be zero. It'd just make the math easier, right? Okay? So it'd probably save money on attorney's fees if they just made it zero. And also no gift tax exemption, meaning I can make a gift. Let's say I am from Scotland, as my ancestors are, and let's say I was born in Scotland, I'm a Scottish, whatever they call a Scottish citizen, I guess that's a UK citizen. Let's say I'm Scottish, I'm living here, my wife is Scottish, I make a gift to my wife of my house, $1 million, okay? Guess what? I've made a taxable gift because there's no gift tax exemption, and because my wife is a non-citizen, there's no marital deduction. Therefore, a taxable gift, okay? So those are issues that we have to deal with. There is a marital deduction in the estate tax world by using something called a qualified domestic trust. That's beyond the scope of our discussion today, okay? Any questions on that so far? Okay. Yes, The
word domicile has the same meaning as we use normally for any state tax purpose, or it's a term of art, has a different meaning?
It's a same meaning, but in other words, it's kind of what we say in the estate tax world is my domicile is where I intend to die. Okay? So where am I gonna live to the point of my death? Okay? And so in some ways it has the same meaning as in the income tax world because it's a term that refers to intent, right? And since there's no way the courts can get inside my brain, they look at a list of factors. Okay, where do I go to church? Where are my country club memberships? Where do I own real property? Where does my income come from? Where do my grandchildren live? All these kind of factors come into play, and anything that you can think of that might be a factor could come into play. Okay, so it is not. There is no substantial presence test. There is no 183 days. None of that. Okay.
There's one more question.
Yeah.
Regarding the exemption, you mentioned about the gift tax for a non-resident. You said that $1 million property a Scottish citizen gives to his wife, no exemption. If it is the other way around, like $1 million property in Scotland wants to give to his son who is a U.S. resident, in that case, the exemption does not really apply, right?
It doesn't matter because non-resident aliens are taxed on property situated in the U.S. So I can make a gift if I am a non-citizen, non-resident, living in Scotland, Scottish citizen living in Scotland. I can make a gift of my Scottish property to my Scottish wife, and the U.S. government has no power to tax that. Okay. If, however, I am a U.S. domiciliary Scottish citizen, and I give that same Scottish property to my Scottish wife, maybe she even lives in Scotland, but I'm here, by golly, for the long haul, that's going to be subject to U.S. gift tax because it's my worldwide assets. So if I'm a domiciliary, I'm taxed just as if I'm a citizen. Okay? Similarly, if I'm a citizen, I'm taxed regardless of where I live and regardless of where my property is located. Okay? Okay. So, let's talk about those top 5 techniques, given that sort of background. And let's see, I'm running out of time already. Okay, number 5, GST tax planning. And I've got here a little picture of, you got the grandkids. One has an iPhone, one has an iPod, the other has an iPad, and Grandpa says, I paid. Okay? So the GST tax is a tax on my right as a grandparent to give to my grandchildren, okay? It is a use it or lose it exemption that I get, $5.43 million. So if I have a $100 million estate, from my mouth to God's ears, if I have a $100 million estate, then that GST tax exemption is going to be an important tax planning mechanism for me because by doing that, by simply using that exemption, what can I save? I can save 40% of $5.43 million, whatever that is, $2 million, right? So that's a $2 million savings simply by using that exemption, okay? Here's the problem with it. It overlaps the gift tax exemption. And so, if I want to give to my kids, I give $5.43 million to my kids. I still have GST exemption left, but I don't have gift tax exemption left. And guess what? If I now want to give to my grandkids, I don't pay any GST tax because I use my GST exemption, but I don't have any gift tax exemption left, so I'm going to pay gift tax. Okay? So, it's very important to use the GST exemptions in an efficient way, and that's going to be a recurring theme, I think, with all of these techniques that we're going to talk about. Who knows about the $14,000 annual exclusion that everyone gets for gifts, right? I can give to anybody I want, $14,000 per donee per year. Beware, in the GST arena, the same rules don't apply. So just be aware. I'm not going to get into the differences when it doesn't and when it does, because the law is, in some cases, not exactly clear. But let's put it this way. Before you advise a client to make a gift of that nature, make sure you check those rules. Call me. Okay? All right. Michael.
Yeah, so you may remember the glorious movie that was Batman and Robin. This is Mr. Freeze. Number 4 item is sort of an oldie but a goodie. It's an estate freezing technique, the GRAT. There we go. The idea behind the GRAT is that it's a trust, grantor retained annuity trust, where the grantor gifts usually an appreciating asset to a trust. The trust possibly, we'll get to the liquidating event in a second, will then make annual annuity distributions to the grantor or settlor for either a period of years or the grantor's life. And then when the grantor dies or when the trust terminates, the remainder goes to the beneficiaries. The way that a GRAT usually works is you're giving an appreciating asset because all of what you're trying to do is pass the appreciation onto the remainder beneficiaries at a low tax rate. And if a GRAT is structured correctly, there's no gift tax. What you do is you fiddle with the annual annuity distributions by taking a look at the term of the GRAT and the 75/20 rates. Those are the assumed interest rates that the IRS publishes every year, or every month, sorry. And you make sure that you end up with a zero gift. Then everything that goes to the remainder beneficiaries goes tax-free. So what the idea behind the liquidating event is, if you have an IPO stock or stock that's about to go IPO, or that you have a privately held company that you're planning on selling, if you transfer it to the GRAT prior to that liquidation event, that then happens, you can pass all of that extra growth in the asset onto the remainder beneficiaries at a zero gift tax rate. So instead of having a $1 million but then $5 million asset in your estate, you're going to have a $1 million come back to you in the annual annuity payments and pass $4 million on to your remainder beneficiaries. Where's my stuff? Usually you're going to want to have the remainder beneficiaries be your kids or grandkids or whatnot, but keep in mind when you're dealing with grandkids, you're going to have to deal with that GST tax. These GRATs are great in today's economy because the interest rates are so low. The 75/20 rates are low. I think right now they're at 2%.
They're also great, by the way, because when you spell check GRAT, it comes out as great. It's happened to me many times.
I can't say that I haven't sent an email where it did say great. So, with the 75/20 rates where they are right now, I think they're around 2.2%, something like that. That's the assumed rate that the IRS thinks you're going to make. But if you earn 5-7% on that asset, all of that extra appreciation is going on to the remainder beneficiaries at a zero tax rate. And these are grantor trusts. So, or at least during the term of the GRAT, they're grantor trusts. And that means that you as the grantor, or the client as the grantor, they pay the income taxes. And the payment of that, according to the IRS, is not an extra gift. So you're passing even more out of your estate at a zero gift tax rate. There's just, and these are great when you've got these potential liquidity events coming up. If you've already entered into a contract, to sell the company, it's going to be possibly a little late because we're going to have to get a valuation for that, and it could argue that you're getting to a higher rate. But it's better to do it ahead of time. There's a few considerations for you guys as CPAs when it comes to GRATs. Although not required, we highly recommend you file a gift tax return, a 709. And there's a couple reasons to do that. One, it pegs the figure as to, when you've sort of done the math as to what the value of the assets transferred are going to be for distribution purposes. And that gets us to the valuation as well. But also, it starts the statute of limitations clock running. So if the IRS wants to argue you've made a larger gift, or that the distribution should have been a different number because of the value of the entity, if you start the statute of limitations running and then they come back to it many years down the line, well, they're sort of out of luck. Regarding evaluation, if you're just transferring cash, you don't need it. If you're transferring publicly traded stocks, you don't need it because those can be valued pretty easily. Cash is cash. But when you're dealing with a privately held stock or even real estate, if you're transferring a real estate to a GRAT, which is not usually the best idea unless you know it's going to be sold, because it's sort of hard to make the annual annuity payments back to yourself in fractional interest with real estate. You have to get an appraisal every year, unless you sell the property. But with that, you're going to need that valuation so you know how to make the annual distributions every year, because those annual distributions are calculated off the initial value of the property that's transferred. So if, as we recommend a lot of times with these, 2-year GRATs, which we recommend you do them, they have very low cost to set up, and there's really no downsides even if you don't get the benefit. You're going to need to know in year 1 what 57% of the value of the property when you transferred it in was. So you have to know that going into it. And back to that low cost, it makes a lot of sense when you've got a lot of money to set up rolling GRATs. Set up one that's 2 years, and then year 1, when that distribution comes out, set up another one, and then just keep rolling them through. And as you do that, all that appreciation keeps going on to the next generation. The other consideration is a tax ID number. You may get some pushback from a bank, but as a grantor trust, it is not required. And if you get one and you get a 1099, but you file it under the grantor's tax return with their social security number, that 1099 is being issued under the other tax ID number, and the IRS may pick it up and say, hey, where's that income tax return? And then you'll just have to deal with that. And you say, okay, it's a grantor trust, we didn't need this, but it's just that extra hassle. Now that being said, some banks are really picky about it and won't set up a bank account using your social security number or the client's social security number, even though it's a grantor trust, and you have that argument with them. So you might have to get one anyway. And lastly, GST issues. Grantor trusts are, or GRATs, are sort of in this limbo when it comes to GST tax. Because if you do not outlive a GRAT, a portion of that is included in your gross estate. Therefore, you can't apply GST tax exemption to it until the term of the GRAT is over and it's no longer included in your estate. The problem with that is when you then can apply the GST tax exemption to it, it's valued at that higher new valuation of what the assets are at the time that they go to the remainder beneficiaries. So usually I don't necessarily recommend using GRATs for grandchildren or that next generation just because of those GST tax issues, and you could end up having to pay GST tax or waste a lot more exemption than you would otherwise have to do. That's why I say children are great for this. The next strategy in today's good markets are a CLAT. Now, this is the charitable remainder trust's cousin, where instead of the money going to the charity and the remainder, it goes to the charity first. So CLAT stands for Charitable Lead Annuity Trust. And in this case, unlike the CRT, Charitable Remainder Trust, well, it starts off the same. You gift assets to the Charitable Remainder Trust. But unlike a Charitable Remainder Trust, during the lead interest, the term of the trust, the annuity payments are made to charity. And then when the trust term ends, 10, 20 years, whatever it is, the remainder goes to the beneficiaries. There are two primary types of CLATs. And luckily, spell check doesn't have a problem with this one because it doesn't make any sense anyway. It just tells you you're wrong. There's this traditional version where you have the remainder going to other third-party beneficiaries. And I'll come back to this slide in a second. But the non-traditional version, the remainder can come back to you as the settlor, thus pissing off the remainder beneficiaries. The idea behind the first one, and the reason there's two different ones is because the first one entitles you to a charitable deduction for gift tax purposes. The idea behind this one is to make a leveraged gift to the remainder beneficiaries. So by putting an appreciating asset into the CLAT, valued at $5 million, based on whatever the annuity payments are, you take the present value of that, subtract those out, and so after the term of the CLAT, it'll go to the remainder beneficiaries at a reduced gift tax rate. The idea behind the other one is that when it comes back to you, by structuring it this way, you get an income tax deduction up front, and it can be sizable. This one makes a lot of sense when you've got a client who has a significant income event in that year, and they've got an ability to pass something off to charity and take advantage of the income tax deduction. The idea with this one, though, is you want to make sure that whatever you're gifting into the trust, the basis equals the fair market value, because you don't want, when they sell that asset, you don't want a huge income tax hit in the trust itself. Because in the first one, where it goes to the third-party beneficiaries, this is not a grantor trust. The trust will file its own tax returns, but it gets a charitable deduction for whatever it pays out. So in theory, it's not going to pay any income taxes. It's just got to file returns. However, this one is a grantor trust. So you get the benefit when it comes back to you. A, you get the assets back, which is always nice. But B, you get a huge income tax deduction based off the present value of all the annuity payments that are going to go to the charity. So that could end up offsetting your income event pretty nicely. The downside is, and this is why you want the basis to be fair market value, the downside is because it's a grantor trust, you have to pay the income tax on it for every year. But that can be mitigated with the investment strategy. If you're investing in tax-free investments, municipal bonds or low tax things, you're not going to have that huge tax hit, and then the annuity payments are still going to be made to the charity, and you're going to get the benefit at the end by getting the assets back. There are some downsides to this. Unlike the other version, the gift one, that gets pushed out of your estate. This one, if you don't outlive it, A, it's included in your estate. Well, it comes back to you anyway, so it's going to be included in your estate. But B, if you don't outlive it, the unpaid annuity payments that were supposed to have been made to the charity will be includable in your income when you die. You have to recapture those. And so that can be a downside, especially if if you've got a 20-year grat and you die in year 1. It sort of defeats the entire purpose of it, because you're going to have to pay a lot of income at the end of that, or right when you die.
That's what life insurance is for.
That is what life insurance is for. And sadly, we don't have enough time to talk about life insurance, but I highly recommend it for clients with not a lot of liquidity in their estates. This is good, again, for when you've got accelerated RSUs, where the basis is going to be the same as the fair market value, and that they're going to go at some point. And it's good if you have clients with huge income events that they need to deal with. Also, a CLAT doesn't make a lot of sense if your client doesn't already have philanthropic goals, because why would they? There's other strategies that they can use to minimize tax hits, or estate tax hits, what have you, that don't go to charity. But if you've got a client that makes annual gifts to specific charities that aren't based on some contract of obligation, these are a great tool, because you can make a specific dollar gift to the annual, structure it so it's a specific dollar gift that you would have otherwise given, and you get the benefit of it. Again, considerations for you guys, file 709. Unlike a GRAT, these are usually required for a CLAT, because especially if you're doing the give tax version, you need to report the amount of the gift to the remainder beneficiaries. And again, evaluation for this one is definitely required. When you're taking a charitable deduction, and it's not a publicly traded asset or cash, you have to have an appraisal done by a qualified appraiser, as defined by the Treasury regs, which means usually it's someone who's got experience in valuing these assets, as they go. EIN, when you're doing the more traditional one, yes, you will need an EIN. When it's a grantor trust, same issues apply. You don't really need one, but Sometimes you might have to get one if you're dealing with publicly traded stock that's held in a brokerage account and your financial institution tells you, no, we won't open an account absent a new EIN. And at that point, you just have to deal with it. And if the IRS comes knocking at your door saying, why didn't you file a tax return for this EIN, you say, because we didn't need it. And then lastly, GST issues. Again, anytime that an asset is still includable in your estate for estate tax purposes, you cannot apply GST tax exemption to it. It's called the ETIP, estate tax inclusion period. And again, once that period ends, you can apply exemption, but the value of the exemption that you're going to need is based on the value of the assets at that time. And hopefully, those assets are worth a lot more when they pass to the remainder beneficiaries. So you don't want to have to use up more exemption than you need to. So you got to be careful if a client comes to you and says, I want to set one of these up, but I want it to go to my grandchildren, or I want it to be in a continuing trusts, for my children and then grandchildren and great-grandchildren, as long as you're in a state that allows that. California not necessarily being one that does. You just got to be real careful, and you got to let them know that the GST tax is going to be an issue, and there's not necessarily a lot of ways to mitigate it when it comes to that. So,
thank you, Michael. Okay. I'll give you that. Let's see. We've got a couple of minutes left. Good. Yeah. Any questions so far? Anybody have anything they want to add? Art.
I have one. On your numbers and aliens, I'm assuming you're now you see it letting you go. How about gifts of U.S. currency and
It's a good question. There's no law on it. So the question is whether currency is tangible or intangible property. And to the best of my knowledge, there is currently no law on it. So I would not recommend doing it that way. I would recommend making a gift of foreign currency to a foreign bank. And that way, the question never arises. Everybody understand that question?
If you can repeat and summarize.
Yeah, so the question that Art was posing is, okay, I have a client who lives in, what's a good country to pick? Scotland. Let's pick Scotland. Why not? Anyway, we really shouldn't use Scotland because it's probably covered by a treaty. But anyway, let's assume there's Scotland. And I live in Scotland. Let's say I'm a non-U.S. citizen living in Scotland, and I want to make a gift to my child who is a green card holder, let's say, in the U.S. Okay. If I'm a non-citizen and I write a check on a U.S. bank account and give it to my son, that could be U.S. situs property and therefore a U.S. gift. The question that Art was asking is, what if I have a stack of cash or even a foreign account denominated in U.S. currency, and I make a gift of that to my U.S. person beneficiary? Have I made a gift of U.S. situs property? And the answer is, we don't really know. I would argue no, but I might lose, okay? And so my recommendation would always be, let's make that gift, if I'm a non-U.S. citizen, non-U.S. resident, let's make sure we're making gifts of non-U.S. property, which means a gift denominated in foreign currency to a foreign bank account, okay? Does that make sense? Okay. Yes?
What about the exchange of U.S. dollars for services rendered in a very large sum?
Well, if I'm paying someone for services rendered, then I haven't made a gift. Okay? The question is, have I paid a fair market value?
Or something like a large retainer.
Well, a retainer, if it's for services rendered and I've paid a fair market rate, then it's not a gift. Okay? But I would want to make sure I've got some support for that. Okay. Okay. Anyone else? What question about that? Okay. Let's go on then. What are we on? 3 now, right? No, 2. Number 2, irrevocable grantor trusts. Now, you guys probably can't see. On my screen here, you can really see. That's a stack of money hanging from a string. And there's a meaning behind that. The point is, it's a gift with strings attached, right? Okay? And so, how many here have heard of the concept of a defective grantor trust? Okay? Probably 60% of you. Okay. I don't like that term because nothing I do is defective, right? Ask my wife. And so what it really is an irrevocable grantor trust. It's intentionally a grantor trust. The reason it's called defective is, in the old days, what used to happen is, really old days, before my time even, that's a long time ago, you might have someone make a gift to their child and retain certain powers, certain strings over that gift, right? And so, and the purpose for that in the old days was because you had these extreme graduated tax rates where the very rich parent was potentially paying taxes at 75%, and the college student child was paying taxes at a very low percentage, right? So you wanted to make a gift to the child in a way that would pay a low tax rate, but still have the ability to get the money back, right? And so that's what they tried to do. And so Congress got wise to that, and they enacted the concept of a grantor trust. And what that grantor trust rule says is anytime the trust has the grantor has retained certain types of powers, enumerated powers, that the assets of that trust will be deemed for income tax purposes to be owned by the grantor. So even though under state law you've created a trust and it's owned by the trustee for the benefit of the beneficiary, under federal tax law, I, the grantor, am still the owner. Okay? And so Congress thought they were very wise, and they were, kinda, but then some lawyers, as usual, got wiser, and they we said, we're going to whipsaw the IRS with their own rules, okay? So here was the idea. Let's take a valuable asset, let's give it to a trustee to hold for the benefit of my beloved beneficiary there. And I am going to set forth a whole bunch of rules. It's an irrevocable trust, okay? And I am relinquishing all dominion and control as that term is defined in the estate tax and gift tax rules, okay? But I'm retaining, and this is these little green lines here, I'm retaining certain powers. And in this example, one of the powers I'm retaining is something called a remove and replace power, and that's the most common power that we use. And that is a remove and replace power that says I, as the grantor, have the power to take assets out of the trust and replace them with other assets of equal value. And by doing that, I haven't taken really anything out of the trust. I've still irrevocably given that money to my beneficiary, but I've retained certain abilities with respect to that asset. And therefore, under the income tax rules, I'm treated as owning the assets of that grantor trust, okay? So what does that do for us? Well, one thing it does for us is so what we've done, let me take one back step here. So what we've done is we've used the difference between what constitutes ownership for the estate tax rules and what constitutes ownership for the income tax rules, and there are a couple of little differences, at least under current law. Knock on wood. And so what that means is I've completed my gift for estate tax purposes. For estate tax purposes, I do not own that grantor trust property, and it's not includable in my estate. But for income tax purposes, what it means is any income that's earned on the assets in that grantor trust, I'm taxable on. okay? And as Michael referenced earlier with respect to the GRAT, which is a type of grantor trust, I'm going to have to pay the taxes on the income that grantor trust earns. What does that do? Well, guess what? If I'm paying 40, 45, 49% income taxes on valuable income-producing property on behalf of property that my kids are getting, they're essentially getting tax-free for as long as that trust is a grantor trust. They're getting that property tax-free. So the income grows inside that trust free of income tax to my kids because I'm paying it for them. And guess what? Since it's a grantor trust under the IRS's own rules, that payment of income taxes for them is not a gift from me. Okay? So that can be a really big number. Who cares about a $14,000 annual exclusion if I can pay $1 million in taxes for my kids and pay no gift tax? Okay? So this is way more powerful for someone of significant means than an annual gifting strategy. Okay? So that's one technique. Okay? Or one benefit of this technique. And so very commonly, when we do trusts, just whatever type of trust, an education trust for the kids, or any sort of trust that we put together for our clients, one of the things we ask them is, would you like to be able to pay the income taxes for this trust and thereby make a tax-free gift? And sometimes they say, yeah, I'd like to, and other times they say, no way. So sometimes it's a hard sell, but for clients of the appropriate means, it's a slam dunk. You absolutely have to do it. The other thing that allows us to do is to have transactions with the grantor trust in the form of sales. Okay, because under state law, if the yellow happy face there sells an asset, a valuable asset to the grantor trust, let's say yellow happy face transfers $1 million piece of property to the grantor trust and then sells a $10 million piece of property to the grantor trust and takes back a note, $10 million note. Well, now what happens? That $10 million piece of property maybe grows over the last 10 years by double. Okay, now it's worth $20 million. It's a Walmart or something. Okay, and it's now worth $20 million. And guess what? The grantor trust for the benefit of my kids is now worth $20 million. I transferred $10 million in value in that appreciation to my kids tax-free. Plus I paid the income tax for them. Maybe that trust is now worth $30 million because I've been paying the income tax for them for 10 years. Okay? And when I sold that $10 million piece of property for a note, I paid no no capital gain tax on the sale of that $10 million piece of property because why? Because under the income tax rules, I own that grantor trust. I took that $10 million out of my left pocket and I put it in my right pocket. It's just me selling stuff to me, okay, for income tax purposes. So I have no gain on the sale. And finally, when I die, what does my estate now own? Instead of a $20 million piece of property, I have a $10 million note. But guess what? That $10 million note, who's the debtor on that note? This grantor trust. What do you think that note is worth? If I wanted to sell you a note that's owed by a grantor trust, what are you going to pay me for that note? Well, it depends on what's the credit quality of that particular note. And in many cases, if all we've been charging is the applicable federal rate on that note, the value of that note might be considerably less than the face value of the note. So maybe a $10 million note is really only worth $5 million. So now I've converted a $20 million piece of property into a $5 million note. And I've shifted $15 million worth of assets to my kids, free of gift and estate tax. Okay? Pretty powerful technique. But it requires a client who has the means to be able to pay those taxes for their kids, okay? And the interest in sort of maximizing what they can shift to their kids. Okay? Any questions on that so far? Yes? I'm sorry, I'm having a hard time hearing you.
Go back to the example that you provided where you transfer a house to this trust and then you go back to get the note. When did you get the cash to pay the interest on the note?
Well, it's a $10 million piece of property, right? So it's probably rented. There's some income, and that income is used to pay the note, right? It's probably debt service. It's probably not, maybe it's a fully amortized note. Maybe it's got a balloon payment. It might be structured in a number of different ways, but essentially it's got to be income producing. There's got to be some cash inflow in order to service the note. Otherwise, the note may not be respected, right? Okay? May not be respected for gift and estate tax.
And also, I think you mentioned it, but when you first set this up, when you have a note, you're going to want to make, or have someone make, a seed gift to the trust so that when you make that note, it'll look like there's at least some money in the trust that's capable.
It doesn't look like there's money.
I mean, there is money. There is money. No, of course. There is money in that trust that can service the note, and that way you don't have, the IRS come say this is a sham note, it's really a gift.
Well, then you got to run some cash flow projections, right? And it's not going to work for every type of property because you got to have the ability to at least service a reasonable note that would be respected by the IRS. Okay. That's a good question. Call me. We'll figure it out. Okay? That sounds like a good case to take an aggressive filing position and warn the client that there's an issue, right? Yeah, it's a good question. You want to take a look at the documents, make sure the documents have been respected. If there was a payment requirement, was the payment made? That sort of thing, right? If there was a payment requirement and no payment was ever made and no effort was ever made to collect on that payment, you got a little bigger problem, okay? So these are not techniques that you can necessarily just put on paper and forget, right? It does require some real actions, okay? So one of the advantages of this as compared to the GRAT is because essentially it has the same effect as a GRAT, right? The GRAT that Michael talked about, what it does is essentially transfer appreciation. This also transfers appreciation, but it transfers it at a little higher rate because the note rate is usually a little smaller than the 75-20 rate, which we all CPAs know. 75-20 rate is 120% of the federal midterm AFR, right? So 75-20 rate is not 120%. I mean, the AFR is not 120% of AFR, it's AFR. So a little lower rate, therefore a little more favorable. Also, you get that potential for a discounting of the note on the death side, okay? We hate to do those kinds of plans, but they're out there. And but what are the disadvantages? Well, the GRAT that Michael talked about, really easy to set up. It's a statutory animal. It's right there, and it's not created by some lawyer. It's just available to do. Congress knows about it. Everybody knows it. It's fine. This is a lawyer-created technique. It's a little. You got to be a little more careful with it. IRS doesn't like it, and so you got to make sure you dot your I's, cross your T's. But if the numbers are significant, it's really worth doing this as compared to a GRAT. If, however, you had stock, then it's pre-IPO stock. Maybe a GRAT's easy and fast and quick and cheap. Okay. As Michael said, it requires seed money. You can't just take back a note from a buyer who has no assets. So there have been a number of rulings that have said, well, if you got 10% of the value of the note in the trust, then we think maybe that's okay if you're just charging AFR. Okay, you can get discounts on the front end and the back end. We talked about that. Tax-free gift of the income tax. We talked about that. And unlike the GRAT, because this does not have an estate tax inclusion period the same way a GRAT does, there is an immediate ability to apply a GST exemption to it. Okay. Need to file a 709 for when you're creating that seed gift. That creates business for you CPAs in the room. Valuations are going to be required for any sales or for any gifts to that trust. That's where my friend Jeff there in the back comes into play. He's a valuation specialist. You guys can talk to him afterwards. You're going to need you may not need an EIN, again, because it's a grantor trust. You might be able to just use the grantor's EIN. And then the GST we talked about. Okay. And finally, the number one wealth strategy every CPA should know about for 2015-16 is something called the incomplete gift non-grantor trust. Everybody know who that is? That's our good friend Jerry, and he's saying goodbye, California. Okay, in the old days, it was westward ho. We want to go to California, land of milk and honey, gold rush, etc., fertile ground. Now, we are leaving California, land of high taxes and regulation. Okay? Why leave California? Well, here's a survey done by the Tax Foundation. California is the number 48 on the list of 50 states. There are still 50 states. Number 48 on the list of 50 states in terms of tax and regulatory environment. So taxes are a big part of that. So California tax is a big consideration for many of our clients this year, and we're starting to do a lot of things to help clients leave California. Well, what does it take to leave California? First of all, if you want to be in the safe harbor, you've got to be out of California for 18 straight months. Okay? If you're out of California for 18 straight months, Franchise Tax Board says, okay, you're out of California, you're not a California resident. But what if you're out of California for 6 straight months, but you bought a house 8 months ago, and this entire year you've been out of there? Well, when have you actually left? Well, there are no bright lines. It's very similar to the domicile question in the estate tax arena we talked about earlier. Okay? Franchise Tax Board is going to look to your ties to California. And no, not your ties of California, but your ties to California. Your memberships, your churches, your friends, your associates, your business, etc. So for many clients, that's not a very attractive option, moving to Incline Village. Incline Village is nice, but there's only so much Incline Village. So what can we do? Can we shift our income out of California without physically leaving California? So one of the things that's been developed is something called a DING trust. Sometimes called a WING, sometimes called a NING. Okay, who's ever heard of those? Anybody ever heard of those? A couple of people. What this stands for is, DING is Delaware Incomplete Gift Non-Grantor Trust. So it's kind of the opposite of the intentional grantor trust. This one is not a grantor trust, but it is also not a completed gift. In other words, the trust is its own tax-paying entity, but we didn't make a completed gift for gift tax purposes when we formed it, so we haven't used any gift tax exemption, and we don't have any gift tax consequences. Well, how can that be? Well, what we do is we form a trust in a state that conveniently has zero income tax rate, and I know I'm running out of time. Common states to use: Nevada, Delaware, Wyoming, and South Dakota, okay? For a number of reasons. One, they have favorable trust laws, and two, they have favorable trust tax laws. Okay, so we form a trust. We have to get a foreign trustee. When I say foreign, I mean non-California. Typically, it's a trust company located in one of those states. We form, in the case of a DING trust, a Delaware trust, we get our Wilmington-based trust company. They hold the assets, and then the assets that they hold are sold, and we recognize that liquidity event income after those assets are held by that DING trust. And therefore, what have we accomplished? We've accomplished the avoidance of California income taxes because the taxpayer was a Delaware taxpayer, conveniently zero. But what about what if I want to get the assets back? Well, here's the thing. You'll notice, and it's hard to see on this projection, and maybe even hard to see on your printouts, this is supposed to look like water droplets. What this is a sprinkling trust. So what happens is the trustee is given the power to sprinkle the benefits of the trust among a number of beneficiaries, including my children. Oh, and by the way, me also. Okay? And what's not shown in this diagram is typically we have a board of, essentially a board of trustees that helps make the distribution decisions so that no one person has the ability to make that distribution decision. Okay? But we structure it in a way that's very friendly, like that, so that I am one of the potential beneficiaries and the assets can come back to me. But beware of this strategy. It does work, we think. It is, however, relatively untested in California courts. It's been tested in other jurisdictions. It is a lawyer-created technique. It's not in the statute explicitly in this format. And California has something called a throwback rule. So what that throwback rule says is if within 5 years after I've transferred that, or after the income is recognized by that ding trust, if within 5 years after that income is recognized it comes back to me, California is going to tax it as if it came to me in that year that it was recognized. So what it means is we have to be able to hold that income in that ding trust for at least 5 years in order to avoid the California tax. Okay. Any questions on that? Because I'm running out of time. Thank you very much. If you have any questions, ask Michael or me afterwards. One final conclusion is one of my favorite non sequitur cartoons. And it's the Lawyer Appreciation Day parade. You got the divorce attorneys, the tax attorneys, the trial attorneys. And the guy says, okay, if people don't come out to show their support by noon, start sending out the subpoenas. Okay.